Good morning. You are listening to The Morning Run. I'm Shazana Mokhtar with Philip C. and Wong Xiaoning. It's 7:06 a.m. on Wednesday, the 25th of June. For some thoughts on what's moving international markets, we speak to Michelle Schneider, Chief Strategist at Market Gauge. Mish, good morning. Thanks so much for joining us today. Let's start off with data coming out of the U.S. economy. The Conference Board Consumer Index did release its latest data yesterday, which showed that consumer confidence took a turn for the worse. What's driving this, and what is then the outlook for the U.S. consumer moving forward?
Well, good morning to you. Well, it was a surprise because the retail sector has actually held up well, all things considered. But what we saw today is the stress that consumers are still feeling in areas of the market, like, for example, the fear of inflation, housing prices, which are very high. The Fed has not done anything to lower the interest rate yet. And even though we saw an oil drop from the peak of the Middle East, gas and oil prices have been rising even before the crisis began. And so you put all these things together, what you really have is, even though the market is so close to all-time highs, the retail sector itself, as measured by XRT, which is an ETF we like to use, is still 30% away from its peak, which was in 2021. So it just goes to show you that the consumers are not necessarily really feeling the roseate picture that the rest of the growth stocks are portraying.
And Mish, what's your take on Jerome Powell's congressional testimony yesterday?
Well, he didn't really say anything that we thought was a big surprise. We have PCE coming out this week, so maybe that would be a little bit more elucidating for him. But essentially, he's still concerned about inflation because regardless of what happened in the Middle East or whether we reignite or oil prices go up more from here, he is watching the impacts of the tariffs. And so he did say that he thinks that we haven't even seen that impact, and we will more as we get into July. And of course, we know July 9th is the deadline for tariffs that President Trump has made. And we've been seeing a very emboldened Trump. So it's possible that he gets more aggressive, in which case right now they're anticipating a September cut. However, if things kind of stay status quo, he did hint at maybe a July cut. So we'll see. I don't think rates are going to go much higher, but it'll just be a matter of time when he finally makes that decision to cut.
Mish, can you help me understand what's happening in markets? Because there's so much bad news. There's geopolitical tensions and uncertainty with regards to inflation, perhaps weakening global trade, especially with unknown tariffs. Yet the markets are inching up to an all-time high. It's as if it all doesn't matter. Is this just the calm before the storm?
Well, that's a really good question because people are getting very bullish here when we're just about 1.5% away in the SPY and the Qs from the all-time highs. And yet it's very possible that we could see it go through. It's the retail space that's been buying this market. The institutional investors have been selling into this. And CEOs of some of the big companies, including NVIDIA, are also selling into this rally. So it's possible we may see a blip up and then a failure from the highs, going more into I think a trading range, particularly if we're looking at the S&P. 5,800 would be really good support. But overall, yeah, we had the latest crisis here with the Middle East, but we still have a very high debt. We still have government spending extremely high with the big, beautiful bill not even signed yet, but that increases the spending. We still have interest rates at a point where paying back the debt is very expensive. And we still have a geopolitical situation where foreign countries are not necessarily buying our treasuries or our dollar. So it's something you have to watch for. And I think the name of the game here is to be very nimble as we get closer to the highs. You don't want to chase, rather be a buyer of dips.
And in that regard, then, are there any sectors in the U.S. equity market that you'd be watching for dips?
Yes, well, I particularly like, and I think we haven't even seen the biggest impact yet of what's going to happen because of the diet drugs. There is more and more stories coming out every day that the muscle destruction that people thought when you take the drugs is not necessarily the case. So we're going to have what they figure could be 6% of the GDP of people who are the new thin economy. So anything they would buy, skincare, supplements, going to the gym, exercise clothes, you would have to watch the trends and see, but that's something that we're looking at, including the diet drugs themselves. We like things that are made in the USA. We're looking at chemical companies. We're looking at companies that really supplant the chips, the things that make the things, so to speak, especially if they're made in the USA. And I also still like certain commodities. I don't think we can rule out silver. Uranium's certainly been on a tear. Copper's looking pretty good. Lithium's been good. So you have to be a little bit diverse here, I think, in how you're picking and choosing.
Mish, crude oil prices have returned to levels before the Israel-Iran tension started. Is the worst over?
Not necessarily. What's so interesting about that question is June 4th, I wrote a blog about how oil was going to surprise the bears. We do have, even though there's a lot of talk about an oversupply and now rumors that Iraq could unload some of his oil, the truth of the matter is that in the United States, we've been using some of the reserves. We have sort of peaked out in terms of shale oil. We have a grid system that has already been stressed coming into right now, a heat wave throughout the country and a drought. We have tremendous energy demands from AI and data centers. And so just take that geopolitical situation, and all we did today in the U.S. was retrace to the breakout over $64. So I do not think the worst is over, and I would not be surprised to see some catalyst to drive the oil prices right back up again.
Can we talk about the US dollar, please? Because shortly after the US launched its attacks on Iran, the US dollar actually bounced. But on a year-to-date basis, it's against the Bloomberg US dollar spot index, is still down 8%. Is US dollar still a safe haven, and has it lost its shine as king dollar?
Well, relative to the price of the dollar and how we're seeing it against foreign currencies, I don't think we have to worry yet about it losing its reserve status. And certainly, by the way, speaking of Powell, that was one of the things that he said today. But if you look at a technical chart, we broke a 6 to 8 year business cycle low. So the trend is down, no doubt about it. And where can we go? Unless we can get back over 100, if you're looking at DXY, I think we can see 90 pretty easily by the end of this year or into next year. And of course, then we have to decide what is that going to do for inflation and for purchasing power for the consumer. Not very good.
Mish, thanks as always for the chat. That was Mish Schneider, chief strategist with Market Gauge, giving us her take on some of the trends that she sees moving markets in the days and weeks ahead.